Okay, guys, we're going to go ahead and get started. As you can see on the screen, I have the syllabus up as a reminder that everything is going to be due Friday. So by everything, I mean the guest speaker write-up, the financial statement analysis write-up. If you have been missing classes and you have to send in that 5-page write-up of the classes that you missed, those will also be due on Friday. And so for folks that have chosen to miss quite a few classes, you have quite a mountain to climb. By 11:59 p.m. on Friday, you have to turn all those in. As I've stated before, with peace and love, there are no exceptions to those rules. There are no reasons that you can provide us that will allow us to extend those deadlines for you. Okay, so make sure you're getting everything done and submitted. Just to make sure we're clear where things are appearing on Canvas. Just taking a look for the submission on the various items, paper guidance, and you can see the guest speaker, guest speaker submission, and then also the financial statement analysis paper submission. That's where you submit them. Don't email them to the teaching team, submit them here. They can't be inundated with the emails for all the classes. You submit them there, then they have them. That's due by 11:59 p.m. on Friday. Question? Okay, if there are no questions on that, let's go ahead and let's start to take a look at the slides. And we have slides left that we want to cover, information we want to cover for chapter 24, okay, which I'm going to do that chapter first, and then chapters 22 and 23 dealing with budgeting. Now, frankly, all of these chapters that are left are dealing with budgeting. Okay, the question is, what is the time frame associated with that budgeting? Thus, the difference between chapter 24 and what I've combined for chapters 22 and 23. And of course, I always have to forget to get my clicker out. So annoying. I know it's in there. Okay, and for chapter 24, okay, and I said the difference between what we're going to see for 22, 23 combined, and for chapter 24 is what is the time horizon associated with this budgeting, okay? And in chapter 24, with capital budgeting, we are looking at a time horizon that extends beyond the current year. So here the company is looking out into, 3, 4, 5 years in the future and saying, should we invest in some sort of property, plant, and equipment, some longer term items, okay? We call that capital budgeting decisions. And we're going to see that we're looking at things dealing with longer term decisions like plant expansion, equipment selection, financing of the project. Should I lease or should I actually go ahead and buy the item? Are there some opportunities for cost reduction? Do I have some sort of replacement that I'm going to have to make of equipment going forward? So you can kind of get a sense as to the nature of some of these things, that they are longer term. Okay. Now, we can use them for two purposes. One, screening decision. Is something going to meet the amount of return that we would think would be sufficient for the use of this capital? That's a screening decision. Or what? Comparative decisions, preference decisions, which item will provide the company with the most profitability. So we'll see that we have some different tools that we'll be using. One is the payback method, very simple, but not as useful as the most commonly used one up here, the net present value method. And then we'll also talk about internal rate of return. Now look, there are other ways to make these sort of analysis, but these are sort of the big three, if you will, and net present value being the most widely used method to make these sort of decisions. Now, obviously, there are going to be cash flows associated with the investment. Companies don't invest in property, plant, and equipment because they want a new shiny red truck, okay? They are making these decisions because they think there'll be cash flows associated with this project coming in or with this investment in property, plant, and equipment coming in. So there'll clearly be cash inflows, but of course there will be what? Cash outflows, okay? So we need to consider both the cash outflows associated with the project, the cash inflows associated with the project or the thing that we're thinking about investing in, okay? Now, cash outflow, the obvious one here to the right is the initial investment. How much are we going to spend up front for whatever this particular item is, okay? Then what? Is there a repair and maintenance that'll come out at a later date when we have to update the equipment or whatever? Incremental operating costs. We're getting involved in this project. What is it going to cost us to get involved in this project? And there is a potential tie-up of working capital. Now, just for simplicity's sake, when we think about working capital, let's just think about cash, just to make it simple, okay? What happens? Let's say I get involved in a project, and I'm going to need some sort of, I don't know, lubricant or some sort of materials associated with this project. And so I go to the company that's going to provide me those materials, and they say, well, that's fine, but there's containers that you will need to maintain the lubricant or the fiber or whatever it is that I'm going to need to do this project. And we're going to make you give us a $100,000 deposit for those particular containers. And you have to give us that $100,000 deposit. When the project's over, you give back the containers to us, and we will do what? Give you back your deposit at that point in time. Okay, so if we had to what? Kick out $100,000 as a deposit for, say, these containers in this little example, that would be a tie-up of working capital. Right now, just think of working capital as cash. That would be tied up at the beginning of the project. Now, when we think about the cash inflows associated with the project, at the end of the project, let's just start with the release of working capital. At the end of the project, what happens? They give me the $100,000 back, don't they? So that money comes back to me at the end, so I can count that as a cash inflow. Obviously, what? There are going to be incremental revenues. I'm going to generate additional revenue from this thing. Or why am I investing in it? There's no reason to invest in something if it's not going to create some more revenue, okay? Then what? There could be the salvage value of this equipment that'll come back at the end after I'm done using it. I can sell it for $1,000 or whatever. I'd consider that cash flow coming in at the end. And then maybe I've invested in this equipment because it is more efficient, and so there's going to be a reduction in operating costs because the new equipment has, more efficiencies or something than an older machine or something like that. Okay, these are the cash flows to be considered, both the inflows and the outflows. Now, because we're going across time, we have to consider, and I mentioned this a little bit last time, or a couple times ago, I don't know when I mentioned it last time, but when I mentioned it first, but the present value of cash needs to be considered, the time value of money, okay? What the time value of money says is this: if I'm going to be getting, say, $100,000, just making a number up, and I'm not going to get that $100,000 until 5 years from now, to understand what that 100,000 is worth to me today, I have to discount that to present value. So think about that. You're saying, I'm going to get 100,000 5 years from now. Gee, that 5 years that I have to wait is kind of a drag, isn't it? Okay. So present value, that's really only worth 95,000. And the question becomes, should you spend a certain amount of money now if all you're going to get is what? On a present 100,000 5 years from now, which is really worth less to you today, isn't it? So you always have to discount those cash flows. The way to think of the discount is what? The present value is always less than what? Than that future value, because of the fact that you have to wait. Time value of money. Okay? Now, you can see we talk about time value of money and then the discounted cash flows to come to that present value. And we're going to practice with some of those calculations here in this chapter as we go through and consider different examples. Okay? Now, the first one, though, that we're going to talk about is payback method, and we're going to put up some advantages to payback method after we've talked about it, but I'm just telling you now, the major disadvantage of the payback method is it does not consider the time value of money. So we won't be using any present value calculations for a payback method. Okay? So the payback method says, hey, how long is it going to take me to recover my investment, ignoring present value, ignoring time value of money? Okay? And so what you would do is you would take the initial investment, what's it going to cost me to invest in this thing, and then you would go ahead and divide that by the net annual cash inflows. That's the what? The inflows minus those outflows would give you the net inflows. And again, we're assuming if we're doing this, it'll be net inflows, or there's no point in even doing it, right? Okay, so you can see in this example, this company wants to invest $140,000. They're thinking they'll get initial cash inflows of $35,000. How long is it going to take them to recover this? Very basic, rudimentary calculation. And they say, hey, the company has as a policy, we're not going to even consider anything unless it will be paid back in 5 years. Okay, so we go ahead, we take that what? Very simple, guys. 140,000 divided by the 35,000 annual cash flows. It'll take them what? 4 years to recover this investment. Should they do it? Since the policy was what? 5 years, they would go ahead and do that, right? I mean, you know, if somebody came down and told them, hey, you only have, 2 years to live, they wouldn't do this, right? Okay, so there's no policy as to how long it should be. There's no, a standard, I should say, that says how long it should be. It's really depending on the decisions of the company. Question. Okay, now, as we've said, strengths and weaknesses, what are we doing with the shortcomings, the weaknesses? Big one, ignores the time value of money. It also ignores cash flows that will come in potentially after this arbitrary payback period of whatever it is, 5 years in this example. What if in year 6 you're going to get $10 zillion on this thing and you decide not to do it because it didn't meet that 5-year threshold? So a couple of pretty obvious big shortcomings. So you say, well, why does anybody use it? I would think it might be just used as an initial screening tool based on some macro understanding of the company's situation. Okay, for example, just a personal example, I get these people knock at my door. Hey, would you like to add solar to your house? And I says, okay, sure, come on in. What's going to happen here, right? And they go ahead and they explain the whole thing to me. And by the time they get done, they sit there and they say, okay, so you're going to start to pay back on this thing. You'll cover your initial investment in 20 years. I'm like, well, I'm going to be dead in 20 years. I mean, that just doesn't work for me. Thanks, guys, but I'll see you around. Okay, so there might be something bigger that just kind of use as an initial screening tool. That payback method would be pretty easy to calculate. Okay, now assuming you kind of got back past that initial one of payback, then a company would maybe turn to a deeper analysis. I'm making that point, not that all companies do it this way, but these are not mutually exclusive tools. It's not like you can't use payback and then say, okay, now that I've passed the payback hurdle, let's go a little deeper and do something else that's going to consider the important factor of time value of money, present value calculations, and the most commonly used one is going to be this net present value. Okay, so let's just go ahead and take a look at that. And calculating net present value, we'll think about cash inflows and outflows again. But now we're going to have to do what? We're going to have to discount those cash flows to present value, and we will accept projects that have a present value of 0, net present value of 0, or a positive net present value. Now look, projects only have a 0 net present value in textbooks. Okay, the reality is what? That most projects will either have a negative or a positive net present value. If it has a positive net present value, we accept the project. Negative net present value, we will typically what? Reject the project. Okay. Now, when we do this and we have to use present value calculations, okay, consider the time value of money and present value calculation, we will need a discount rate. That discount rate is often determined, or is always determined by the board of directors, and we can use different factors. A common factor that is used beyond the scope of this class to come up with the discount rate is something called the capital asset pricing model. Capital asset pricing model says, hey, look, what is the type of financing that we're going to use for this project? Okay, for example, we may want to issue some stock. We may want to sit there and do what? Float some bonds, okay? And have an interest that we have to pay. And so what the capital asset pricing model says is, all right, we're going to sit here and we're going to use a risk-free rate of return for this entity. Risk-free rate of return is a rate of return associated with treasury bills, U.S. securities. Because what? The idea is that U.S. securities don't default unless you get a government that sits there and starts to say things like this. You know, we've issued too much debt, and the other countries are just going to have to deal with the fact that we're not going to pay back our debt. Anyone who bought our treasury securities, you know, we've been too much in debt and we're just not going to pay back. Then there is no such thing as a risk-free rate of return anymore, and what you have is chaos. So when that happens, lock your doors, okay? Now, what happens? Assuming something stupid like that never happens, then what we would do is we would go ahead and we would start with a risk-free rate of return, and then we would come up with a multiplier for that depending on the risk of that particular entity. And what happens is we take their risk and then we adjust it for how they are different from the rest of the market, and we come up with the cost of our capital from that, and that becomes the discount rate that we would use in these calculations. Now again, beyond the scope of this class, I could probably dig into the capital asset pricing model just to torture you. That is a finance class discussion that you would have plenty exposure to if you want to be in the decisions to decide what the appropriate discount rate is. Once we have the discount rate, the accountants take that and do the calculations that I'm talking about here now, the present value calculations. Okay, so we go ahead and they talk about some cost flows that are going to go with this thing, and so there'll be the initial investment of $160,000. There's that working capital requirement, right, for the containers, the deposits, whatever we have to make. There's what? Relining of the equipment that's going to have to be done in 3 years. And then salvage value of the equipment, that's some money that's going to come back to us at the end of this project, right? Now that working capital is going to go out at the beginning, but it's going to do what? Come back at the end, okay? Then what? Then we have the sales revenue, okay, that we think we're going to get from this, but we're going to have to have a cost of whatever the parts are that we sell. Remember, we're going to incur material costs, labor costs, probably some overhead, right, to go ahead and construct these items or produce these items, and then we'll have things like salaries and so forth that we'll have to pay over that period of time. So we have some inflows, we have some outflows. Now, the hurdle rate that we're going to use here, or the factor that we're going to use, the discount rate that we're going to use, is 11%. Again, handed down to us from the board of directors, from our finance department, probably using something like a capital asset pricing model is what's a required rate of return for this, right? We use this rate of return because the question is, well, look, rather than do this stupid thing, just put your money in the bank and you'll get some return on that. Well, the presumption is that what? If we go ahead and we invest it in this project, whatever, we'll get a higher return than if we had just done a risk-free investment in, say, a treasury bill or something, right? So we want a certain return, and this one is 11%. So We come up with the net cash flows, sales revenue, $750,000, cost of the parts, $400,000, the salaries. So we're going to get net annual cash flows of $80,000 in this example. Okay. Now what happens? Now we have to consider time value of money. Now what happens? The initial investment, the $160,000, and the use of that working capital, the deposit for those containers or whatever it is that's going to come out today, isn't it? So I don't have to discount that because that's already in present value. So I have those two amounts. Then I start using present value calculations for these cash flows that are going to take some time to come in. Now, if you notice this first one for years 1 through 5, the number is greater than 1, isn't it? Why is that number greater than 1? It's greater than 1 because it's going to be more than one cash flow, isn't it? It's going to be 5 years of cash flows. You say, well, why don't you multiply that by 5? I don't multiply it by 5 because I need a what? Present value, which is going to be less than the actual amounts that are coming out, and so it's a factor that is less than 5. These other payments that you see here are amounts that are going out or coming in. Either the salvage value and the return of working capital are coming in. The repair, whatever I'm going to have to do, or realignment of the equipment, whatever I have to do, is going to just come out what? One time. I only do that once. So here I have a factor that is less than 1. You say, well, why don't you multiply it by 1? I don't multiply it by 1 because, again, what? The present value is less than the amount that's going to come out in future periods. Now, just to give you a sense as to where these factors come from, in these days, you know, Excel is pretty robust in being able to make these calculations for you, okay, and various things. But just to see where some of these numbers came from, and let's start with this annuity. Let's start with the dollar, the single payment. Okay, let's start with that. So what happens? They told us that the project had a what? 11% required return. So we go to the 11% column. And for that first one where we were going to have to fix the equipment after 3 years, the row we go to is 3 years at 11%, and the factor is 0.73119. And so if you look back, I'm not going to go back into slideshow mode, guys, because it's just easier to show you here. You see that 0.731, whatever, they rounded it, but they turned it into present value. Okay, instead of it being 30, its present value is 21,930. It's less. Okay, then what? Let's just quickly take a look at these other two, 0.593 for the return of the working capital and the salvage value of the equipment, which won't occur until 5 years. So here we still stay in that 11% column, but for that one we come to the 5% row, 0.59, not 5%, but 5 years, 0.59345, 0.59345, and you can see that that's pretty much the factor they use there, a little bit of difference in rounding. Okay, so we came up with the present value of those one-time payments from that table, right? That's where they got those factors. One-time payments or cash inflows, whatever. Okay, now you come over, and for this 80,000, the net annual cash flows, there's going to be 5 of those. So now we need to go to a different table. We don't go to the present value of a dollar. We go to present value of an annuity. Okay, annuity is what? Is a series of payments. Okay, when you get to a point in life, you're going to want to, be able to make an investment so that you get an annuity for the rest of your life, meaning you don't have to work anymore. Cash flows will just come in for you, right? Here, we're doing it in the terms of this project. Okay, so again, the interest rate is 11%. It's going to be how many payments? It's going to be 5 payments. So we come down, and at 11%, I must have been looking, ignore that I circled the 10 and the whatever I had circled before. That must have been some other example I was using. But here, see this 0.379079. I mean, now I'm confusing myself. 11%. See this 3.69590? See that number right there? Okay, that's where they got this number that you see here, this 0.3696, and there's some amount of rounding that's going on there, but that gave them the present value of those future annuity payments. Now, the net present cash flows that are going to come in. Now, a couple of things about these tables that I point out, and again, Excel's pretty good these days, but notice, guys, what? All the numbers on the present value of the annuity table, because it's more than one payment, all of those numbers are greater than 1 because it is more than one payment. Okay, when you look at the numbers, if you're in the 2-year row, notice that all the amounts are less than 2. They're less than 2 because what? The present value is less than the future amount that's going to have to come in. All the numbers that are in the 3-year row are less than 3 and so forth, right? And you're saying, wait a minute, John, for the 1 year, for the 1 period, the numbers are less than 1, and I'm here to tell you that I think for this to be a really useful present value of an annuity table, they should get rid of the 1 payment row because it's not necessary. If I became president, the first thing I do, the executive directives that we get to sign, right? Executive orders we get to sign. I'd sign one that say, from now on, all present value of annuity tables will no longer have a 1 payment row. I'm going to get rid of the 1 payment row. It's not necessary. It's not necessary because we have, for 1 payment, we have a table. We have a table already. The table we have is the present value of $1, the single payment. And if you look at the 2 tables, the number in that 1 column is exactly the same, isn't it? Okay, so a good way to know if you're on the right table, if you're using a table approach, if it's annuity, all the rows that I need to use are what? More than 1. Okay, and if it's a what? If it's a single payment, all the numbers on this table are what? Less than 1. And they would need to be less than 1 so that that present value of that single payment can be less than the present value could be less than the future amount. Okay, question on how the tables work? Okay, now you come over, and let's just go back and take a look. Okay, and they went ahead and they did the discounting, and when they did, this project had a positive net present value of $76,015. This is telling you that you are getting better than that 11% return. And since the 11% return is what the cost of capital is, this is a good investment for us, right? Okay, so again, positive net present value, yeah, do the project. 0 net present value, which, guys, really probably only exist in textbooks. Do the project. Negative net present value means what? Step away from the project. It is not a good project for you. Okay, good. Now, you come over, and another tool that we can use is the internal rate of return approach. Okay, now what internal rate of return, which is not used as much as net present value, it sets a number that will set the initial investment equal to the discounted future cash flows, and you find the factor that will make that happen, and then you go and determine what the return is, and then you determine if that return exceeds a certain threshold, again, that would come down from the board of directors, determined by, capital asset pricing model or whatever. Okay, so let's go ahead and see now an example here where we have this, I guess it's a smog machine that they're going to think about buying. I don't know what that thing is, but they're going to go ahead and purchase this thing, and it's $104,320, and it's going to produce annual cash flows of $20,000 per year. Now, they go ahead and they show you how to set that up, but I like to think of it this way, okay, which is I have an initial investment that I'm thinking about making. Okay, I have determined what are the net annual cash flows associated with that, and I want to know what is the factor that will set the initial investment for the present value of the net annual cash flows equal to the initial investment that I'm considering. Okay, so just using this example, what's the number there? 104,000 what? 320. Thank you. 104,320. They've determined that they have some annual cash flows that they can make from this thing from 20,000, and they don't know what the factor is that's associated with that. They go ahead, though, and they do the algebra, as you can see on the screen. They divide the 20,000 annual cash flows by that initial investment of 104,320, and they come up with a factor 5.216. Then they do what? And I'm not going to put the tables back up, but they would go back to those tables, present value of the annuity table. It was a 10-year project, and they run their finger along that table, if you will, until they find the factor that will make the future cash flows equal to the initial investment. They go up to the what? To the rate of return columns, right? Remember we had percentages going across the top, and that tells them that you are going to get a 14% return on this project. If the hurdle rate was, say, 11%, they do the project. If the hurdle rate was, say, what? 18%, they would reject this project. Okay? Question? Okay? Okay, good. Now, one of the disadvantages of internal rate of return, and the reason that companies these days really entities trend towards net present value, is this internal rate of return approach versus net present value. Internal rate of return approach says you're going to be able to take any cash flows that you get and invest them in something else that will give you that return. So there's what? Always another investment that you're looking for that's going to also give you this same kind of return. And so there's a pretty significant flaw in internal rate of return. Most companies will use net present value. Okay? All right, I'm going to stop there for chapter 24. Let's go ahead and let's just jump ourselves into what I have combined here for us, chapters 22 and 23, so I can close that. Let me close that. I don't need that anymore. Always end up closing something I need, but that's all right. Okay. All right. So I went ahead and combined chapters 22 and 23 here, teasing out some of the significant parts of chapter 22, and then combining that with probably more where we want to focus our attention was in chapter 23. Okay. But what happens? In a company, we prepare budgets. Okay, now again, this is internal, isn't it? I mean, we don't sit there and publish our budgets out to the public. We're not talking about public reports anymore. We're simply saying, hey, internally, what kind of evaluations and decisions are we going to make? Okay, now we're trying to achieve, and forgive this, kind of silly thing with the whip, okay, but what? We're trying to meet certain targets, but we're also trying to achieve control. We don't want cost overruns and so forth, right? Okay, so that's the reason that we put together a budget, okay, and it's more of a planning tool, allows us to sort of see, hey, are we heading in the right direction? Do we need to make any changes? It covers 1 year. We're talking operating budget. This is not capital budgeting like we just talked about, where we're going to go over several years and have to use time value of money, present value calculations. We're just talking year to year as we try to control the company as we go forward, okay? Now, there should be participation. It shouldn't just be top down, hey, do this or else, right? So we have some participation in that process. That makes the members of the team more enthusiastic. They feel they had some participation in it, and it makes everybody sitting there with the boxes a little bit lighter or whatever, right? The fact of the matter is, any budget, anytime you produce a budget and you think, that's a fair budget and everybody's motivated by that budget because they participate in all that, if you think that, you're crazy. The reality is, or you're maybe not crazy, but you're ignoring reality, okay? The reality is what? The reality is you put a budget in place and you think everybody participating and everybody's singing along to it. Meanwhile, everyone's bitching and moaning behind your back about what a horrible budget you gave them, okay? All right, but we have to have something in place, okay? So we go ahead and we prepare the budgets. Now, when we prepare a budget, we're going to be using something called variance analysis. And with variance analysis, we're going to be trying to understand, well, why were we different from what we had budgeted? What caused those differences? Let's put some changes in place to correct that. And then it'll feed back in and we'll do what? Variance from the budget again and see what sort of factors are coming in. Now, to assist in that, we will want something called a flexible budget. We need a flexible budget because if we compared our actual results to a static budget, flexible means it's not static. Static means it's holding the same no matter what. Okay, flexible means it can roll with the changes. Okay, if we didn't use a flexible budget, we would have a problem trying to compare our actual results to our budget. Okay, so we're going to be using flexible budgets, and we're going to use this example of this Larry's Lawn Services. Guy mows 500 lawns. He says that the lawns are all pretty much the same size, and so he comes up with a budget assuming that he's going to mow 500 lawns. He charges $75 per lawn, so depending on the number of lawns he mows, 75 times 500, he's assuming 37,000. He has some fixed costs. Remember fixed costs? Those fixed costs are going to stay the same regardless of how many lawns he mows. And then he has what? Some variable cost in here that the cost will what? Will change depending on how many lawns he mows, right? Okay. Now what happens? He goes and he actually mows 550 lawns. He budgeted for 500, but he got enough business for what? 50 more lawns? Now, he's not going to go to the people and say, hey, look, I've mowed 500 lawns, man, and that was in my budget. And even though I have a capacity to mow 50 more, I'm not going to do it. No, he's going to go ahead and do it, right? Okay. Now, if he's charging $75 a lawn, clearly his revenue is going to be more. 550 times 75 will equal the 43,000, I should say. But some of those costs, those what? Variable costs are going to also go up as well, right? Because he's mowing more lawns. Okay? So when he compares the actual to the planned budget, he starts seeing F is favorable, U is unfavorable, and he starts seeing these unfavorable things in here, and he's like, geez, I guess I messed up because I spent too much money. Did he really mess up? Well, but he mowed more lawns, so there should be increased costs, right? So is it really unfavorable? And so what we can do to fix that problem is go ahead and prepare what, okay, this guy's, I should have switched over to this is the quandary pose. Ooh. Okay, and then this is the guy that comes in and says, well, let me tell you how to do a flexible budget that will help you to, sort of get past this problem. Okay, and so what happens? He prepares the flexible budget, okay, and now what he does, is he sits there and he compares what? The 550, did I hide a slide I wanted here? What's going on here? Flexible budget, 550, what did I do? Hang on a minute, guys. Oh, okay. This is what I want. I have it there, but I'm going to do it here. From current slide. Okay. This is the flexible budget. I don't know why I had that other stuff in there, but this is the flexible budget where he sits there and he says, okay, look, my budget at 550, I take the 550 times the 75, and this is what my revenue should have been. It should have been what? 43,000? Okay, so he's sitting here and saying, look, If I take 550 times 43,000 times 550 times 75,000, I get 43,000. My what? If I take $75 and I multiply it times 550, my what? My revenue should have been 41,250, but it was actually what? 43,000, wasn't it? Okay, so if you take 43,000 and you multiply that, you divide that by 550, what do you get? I'll wait, because I know that's a very difficult calculation for you. I know you're going to have to really, really think about that. Huh? 78 what? $78 even? Huh? 0.18. That's $78.18 of revenue per lawn. But he's only supposed to charge what per lawn? 75. How did he get 78 per lawn? He was supposed to charge 75 per lawn. He's got 78 per lawn. And I'm able to see this now through this flexible budget because I went ahead and set up the budget now if I had set it up for 550 lawns instead of 500, right? All the economies of scale, all the lawn, I don't know economies of scale. All the lawns are the same size. So I'm not sure if that answers economies of scales because I don't know what you mean by economies of scale here, but
it's fake. I was thinking when you like save money because
this was money that was being paid to him.
Oh. Never mind.
How is he getting $78 per lawn, $78.18 per lawn, when he was only supposed to charge 75? How do you get 78.18 when you're only supposed to get 75? Is this how you're going to be in a meeting when the boss asks you that? You're going to go, you expect a raise? How's he getting 78.18?
Is it because of tips?
Huh?
Is it because of tips?
Tips. You mean tips to his employees? So his employees are going to come in and say, guess what, boss? I got a tip. Yeah, they tipped me. Here. Maybe. Okay, maybe. Let's call a meeting of Larry's Lawn Services and say, hey, team, how did this happen? One of the person unfolds their arm and they raise their hand and they say, well, boss, what I do is after I'm done with the lawn, I knock on Mrs. Feeney's door and I say, Mrs. Feeney, we're all done, but I noticed your rose bushes are getting a little too bushy. Can I do some pruning because they'll really grow much, you'll grow better, more beautiful roses. And every time I do that, Mrs. Feeney says, well, how much will that cost? And I said, oh, we'll only charge you a couple bucks for that. Okay. Do that. And so I charge a little couple extra bucks that it's on her invoice. Oh. Everybody knock on the customer's door from now on when you're done. When they see what a beautiful job you did. And they're saying, and you got right when they're looking and they're saying, oh, I can smell the grass growing. I smell grass. How much you want? Man, I'll give you whatever you want. So we came up with what? A better business practice by having this flexible budget, seeing what's going on, right? Okay. Now, let's look at the other side, though, this cost side. And let's just look at the gasoline for a minute. Okay, what happens? The actual results were that it cost them $5,100 for the gasoline per lawn. And they were supposed to, they mowed 550 lawns. What's 5,100 divided by 550 lawns? How much? $9.27 per lawn. They're only supposed to pay $9 per lawn. They're supposed to go down to the Rotten Robbie gas station. You guys ever heard of Rotten Robbie? Okay, yeah. I look around to see who's heard of Rotten Robbie, because then I know what neighborhood you grew up in. Okay, but in Hayward, there's a lot of Rotten Robbie gas stations. Okay, you may not see too many over here in Palo Alto. Okay, but what happens? Rotten Robbie gas stations, where you're supposed to go, where the gas is cheap. We don't need real, premium gas to run lawnmowers. And you're supposed to fill up your gas can at that day and use that to mow your lawns. And that should only be $9 of gas per lawn. They're spending $9.27. Why? Why did we spend $9.27 per lawn when you're supposed to go to the Rotten Robbie and it's only supposed to be $9 per lawn, and all the lawns are the same size?
They perform the extra services.
Huh?
They perform the extra services when they...
Maybe they perform extra services and so they use more gas?
Yeah, as you said, they got more money because...
Okay. They perform extra services so they had to use more gas. Okay. What else? Huh? Maybe the price fluctuates. You mean they're not going to Rotten Robbie? Because we know what Rotten Robbie charges, and that's how we came with that $9 per lawn. Maybe we have a deal with Rotten Robbie. They're going to just charge us that amount per gas. We could control it that way because we buy a lot of gas and we have a contract with them that's what they're going to charge us. Whatever. Okay, so maybe they didn't go to Rotten Robbie. Maybe they went somewhere else, right? Don't forget, we're supposed to go to Rotten Robbie. That's who we have the deal with. It'll keep us to the $9 when we have our little team meeting, right? What else? You say they're using more gas.
The lawn is bigger than they expected.
The lawns are standard size. We're pretty much dealing with the standard size lawn here. If we're adding bigger lawns, then we're going to use more gas, but that should go into our budget initially, right? I don't suppose it's possible that some of our employees, when they were filling up the gas tank over for the gas can for the lawn mowing equipment and such over at Rotten Robbie, I don't think that any of them accidentally then put the thing in their own personal vehicle and filled that up, did they? Do you think something like that could possibly happen? When auditors come in and they design their audit, they are required to do an analysis called analytical procedures at the beginning of the audit to see if anything comes up that makes you go, that's weird. And if you see something like that, you are to turn your attention to that for the possibility that maybe there's a difference from what you expected, maybe not caused by an error, but caused by fraud, like employees doing what? Stealing gas? Okay. So we have what? We have suggested. Maybe they didn't go to the Rotten Robbie where we have a contract. We had it suggested that maybe it's a good thing because they're spending too much gas because they're doing more services. Maybe it's a bad thing because there's inappropriate use of the gas. Can we tease out, therefore, is it a price thing or is it a quantity thing? Is it that we're paying too much for the gas? Or is it that we're using more gas? Or maybe it's a combination of each. But we can make a better decision if we tease out this variance between its price components and its quantity components. Okay? And that's where we're going to go ahead and start to take a deeper look at, not this particular example, but the type of analysis that could be done that would help you to tease out whether it is price or whether it is quantity. Okay? And we're going to go ahead and break these into these three factors of production now that we talked about last time, which is what? Materials. We have materials, don't we? Remember we talked about direct materials? We have what? We have labor. Remember we talked about direct labor? And then you had what? Overhead, which we said was indirect. And we will literally sit here and calculate variances for each one of those, materials, labor, and overhead. And we will do them in terms of what? In terms of price, in terms of quantity. Okay, now when we talk about materials, price, and quantity makes sense as terms. Okay, but when we talk about what? When we talk about labor, we talk about overhead, we talk about rate. Rate is like price. And we talk about what? Efficiency, which is going to constitute the amount of hours we use for our labor. And we'll use those similarly for the overhead. Okay? Okay. So let's look at these price versus quantity. Let's start with materials. Okay? And you have here this company that's producing, I guess, parkas in this little example. And we have some information here as to the materials that they use, the price they paid for those materials. And I'm going to go ahead and do the materials variance first. Okay. And the way I wrote these on the board, the way you calculate these, and on the board, oh, you could also see it on the bottom of the slide. Okay, good. Okay, it's good on the bottom of the slide too. You can see for the price variance, I have AQ. AQ is the actual quantity of materials that was used. And I'm going to multiply that by the difference between the standard price versus the actual price. Now, when I do these, I always put the standard first. Inside the parentheses, I always put the standard first, because if the actual is more than the standard, then that's going to create a negative number in the parentheses. And I like to look at it this way, that if that variance is unfavorable, it's going to be a negative number. A negative is a sad thing, isn't it? It's going to be unfavorable. If that number is positive, because I put the standard first, which means I did what? I spent less than what was expected in the budget. That's a happy thing. That's a good thing. Okay, so I always put the standard first. Okay, now on this slide, the red is what the standard was, and then they tell us what actually happened. Okay, so it tells us that they are supposed to spend $5 per kilogram of whatever this stuff is that they put in the parkas. So at this point, I look at this and I say, okay, if I'm doing the price variance, okay, I'm going to pick my standard price is how much? $5? That's what I'm supposed to spend on this thing, okay? My actual quantity that I use, and in this question they tell me that they actually used what? 210 kilograms of this stuff? That's the actual quantity. So I go ahead and I multiply, I put in my outside the parentheses, the actual quantity of 210. $5 is what they were supposed to spend. They tell me that they did what? They spent $1,029 to purchase $210 of this stuff. So $1,029 divided by what? They told me they actually use what? This 210. Okay, so 1,029 divided by the 210 gives me, I'm getting 490. Is that what you're getting? I'll wait because I know that's a very difficult calculation. 1,029 divided by 210 is... I'll wait because I know that that's really hard. 1,029 divided by 210 is what? 490. Okay, good. So 210, they spent what? 10 cents less than they were thinking they were going to? Is that number negative or positive? Is this a negative or a positive number? It's a positive number. Why? Because we were less than the standard. That gives me $21. And if the number is positive, positive means that it is a what? Favorable variance? It's a good thing? Okay, so they're not paying too much for the materials. Okay, let's go ahead then and let's look at the price. That was price. Let's look at quantity. Quantity is going to be what? I'll just put it right here. Standard price is what? They're supposed to pay $5. Okay. Standard quantity, well, what was the actual quantity? We already know that the actual quantity was what? This 210. Okay, so you pick up that actual quantity of 210. What was the standard quantity? Well, look, they produced 2,000 parkas, didn't they? And the standard was that they were supposed to use what? 0.1 of this fiber fill of this material, whatever. Okay, so to produce 2,000 parkas, they're supposed to use 0.1 per parka. They used what? They used 200. I mean, they were supposed to use 200, and they used 210. So I take the $5, the standard price. I sit here and I calculate the difference, which is what? Negative 10? $5 times negative 10 is what? A negative 50. The number is negative, so it is what? Unfavorable. Put the U there, unfavorable, because it's negative. Okay, now the next slide sort of shows you the way the maniacs that wrote the textbook calculated it. And I only have that slide there just to confirm my calculations, which is what? 21 favorable and a what? Negative 50 unfavorable. The way they calculated, I would not have gone about doing it. I do what? I always put the standard first. So if I'm taking something like the CPA exam when I'm calculating this kind of thing, I don't have to sit there and say, okay, now should I call that favorable or unfavorable? If the number is positive, it's favorable. If it's negative, it's unfavorable, right? The other way, because for a CPA exam you'd have to memorize these things, is I say, well, look, if you're trying to get the price variance, you'll get the price variance inside of the parentheses by comparing the standard price to the actual price. And then you want to just say, well, what was the impact of the fact that I had that difference in price? You measure that by what you actually bought, right? The actual quantity. For my quantity variance, I put inside the parentheses what was I supposed to use versus what I actually used. And so that you don't have any distortion there of a price variance, you use the standard price, so you're only measuring what happened as a result of the quantity, right? If you had to memorize that, that would be the logic. So now you call a meeting and you say, well, why did we have this, negative unfavorable variance for the quantity, but for the price, we had a favorable variance. What the hell's going on? And so you call a team meeting, and that's when everybody starts blaming each other. Okay, so what happens at this point? The guy says, we'll call him Bob. Bob says, I'm not responsible for the unfavorable materials quantity variance. You purchase cheap materials. That's why we had a good price variance, because you buy what? Cheap stuff, and it busts all the time. She says, well, look, your scheduling sometimes requires me to rush and order materials at higher prices, causing unfavorable price variances, whatever. whatever their arguments are. What do we have? Unfavorable price, right? Okay. So what would you do? How would you solve this? I know it's kind of hard to sit in for a whole class like this. What would you do with this? Well, how would you handle these two people? She's saying, I have buying cheap material, he's blaming it on the material. How would you handle these two? Fire both of them? You're fired. You're both fired. How would you handle them? Fire them both? Yeah. You're both fired. Everybody's fired. Well, that would be one way of handling it. Now you got to do it yourself, right? If you fire people that are doing a job for you, then now you have to do. Or you could sit here and say, what I might say is, look, Mary, I'm naming her Mary, spend whatever you have to on the materials. Don't worry about it. Get good quality materials. Don't worry about it. Spend whatever you have to. And then we turn around and we still have what? This unfavorable quantity variance. Now we can just start to focus on Bob and say, what are you doing out there? She got good materials. It ain't the cheap materials because she got the tip-top materials. We all agreed these were the tip-top materials. And you still had a quantity variance. How come? What's going on, Bob? Dig in, Bob. Take a look, Bob. Take a look at that equipment. Are you sure you're maintaining that? Are we still? Let me see the schedule of the maintenance that was done. Oh, you don't have the schedule. Why not? And so forth, right? And you start to be able to drill down as to what's happening that's causing this situation, right? Okay? Okay, good. Now, you can do the same thing for labor, okay? And when you do the same thing for labor now, okay? And I've put the labor variances over here on this other panel up here. Okay, what happens? Now we're going to look at, and we've just changed the word price, and we put the word rate, and instead of using quantity, we're using the word efficiency here. So they tell us in this example that you're supposed to spend 1.2 hours on the parka, per parka, and you're supposed to spend $10 per hour for labor. Okay, so we go ahead and let's calculate that rate variance. And so the actual hours were how much? Actual hours were 2,500, you say? Hours? Okay, good. Okay, and the standard rate was $10 per hour? Okay, which all the employees would quit if you paid them $10 per hour, but let's just go ahead and use an easy number. What did they actually pay the employees? Well, you take this, $26,250, which is what they paid. You divide it by the actual hours, which was 2,500? What's 26,250 divided by 2,500? $10.50. So we're paying the employees $10.50 an hour? When you were only supposed to pay them $10 an hour? So 2,500 times a negative 0.50 gives me what? Negative 1,250, I guess. Meaning if it's negative, I erase the faces now. But if it's negative, it's what? It is unfavorable. It's a U. Unfavorable. Why am I paying them $10.50? I have employees that I've agreed to pay them $10 an hour, and now I'm paying them $10.50. Why? Because I'm nice? Well, that's obviously not the reason. Why is this happening? Huh? They worked extra, so I paid them more per hour because they worked extra? What would cause me to pay more per hour to people that work extra?
Exceed the 1.2 cent hours.
Really? Why did I pay them more? Is it written in the contract that I pay them more if they work past a certain number of hours?
Should be.
It is?
They work at the speed they're supposed to.
They don't work at the speed they're supposed to, so I pay them more? Hey, you, man, you're the slowest one of them parka dudes I've ever seen. Let me give you a little more. This is saying I'm spending more per hour on them. Why am I paying them more per hour? Why am I paying them more per hour? Because they're producing less, so I pay them more per hour? No, you're way off. Why am I paying them more per hour?
Aren't there any measurement errors?
Huh?
Aren't there any measurement errors? Like,
Hours, whatever.
Well, there could be. Garbage in, garbage out. I'm assuming I have good data. If these numbers, got too funky, I guess I'd have to sit here and start wondering if my data gathering is off. Why do you pay people more per hour? I'm thinking there's some folks in here that have never worked. If I work overtime by state and federal statute, I am required to do what? Pay you more per hour. So I'm thinking there might have been some overtime in here that increased the rate per hour, right? That could be one explanation, and that's a likely cause of it, right? Because you agree to pay people $10 an hour, it doesn't shift in the middle of the accounting period. Let's see, you, the slow one, here, take a little bit more per hour. In the middle of I became nice. The ghost of Christmas past just came and told me that I'm no good. That's probably not going to happen. I probably negotiated with a union what it is that I'm going to pay. So probably, I'm just saying, most likely, if the reason that you're going to pay more per hour is there's some overtime incurred here, right? And by contract or by federal statute, state statute, you had to pay more per hour. Okay. Well, let's see if we can get some answer as to, did we work more than we thought we were going to? And that's our efficiency variance. And so for the efficiency variance now, we take the standard rate. Standard rate is how much? $10, not 10 cents per hour. We haven't made America quite that great yet that we're going to pay people 10 cents an hour. Because we want to go back to when America was great. Well, when was America great? Well, America was really great from about 1870. I have to pick 1870 because we had slavery in 1865, and so I can't pick that. So I'll pick from 1870 to it was good till about 1913. You mean during the time where there were no child labor laws? You mean during the time when they locked people up in the factory to make sure they would meet certain production goals? Is that the time that we're speaking of? Okay, so we're not quite where we can pay 10 cents an hour yet. We haven't gotten that great yet. But we pay in this example, $10 per hour. Again, picking up the standard rate. The standard hours are what? Okay, well, do I know the actual hours? Huh? Do I know the actual hours? How many? 2,500 were the actual hours. Can I calculate the standard hours? The standard hours were what? If I produce 2,000 parkas, I'm supposed to spend 1.2 per parka. Isn't that what it says up there? For 2,000 parkas, 1.2 per hour? and I spent then what? I spent 2,500 hours to produce 2,000 parkas when I should have spent what? Only 2,400? That's a variance of 100. A variance of 100 times what? Times the 10, I mean, a variance of 100, yeah, times the $10 gives me what? I know that one's really hard. I know that one you have to think about for a long time. What's 10 times negative 100? Negative 1,000. So I have a what? I have efficiency variance of what? Negative 1,000. Did I use too much time? Did I use too much time? It's looking like the overtime is the problem here, right? That's an agreement, or you had a question? Yeah? Oh, maybe they didn't work the speed that they were supposed to work, yeah. Or maybe what, and then they get those two people start their, back and forth about, well, it's this problem, that problem. So what would you do? Fire them? What would you do? Get somebody out there and say, you over there, work faster. I used to work, I got a job working for UPS, unloading trucks. This is why I'm going to college. And you have to have something like 1,200 boxes per hour coming out of the thing. They measure you. Zoom, zoom. You got to keep the things coming out of the box. And somebody's back there measuring you. And if you don't have 1,200 boxes per hour coming out of the truck, they come up and they say, ah, what the hell, yeah! And I'm like, holy Toledo. Sorry, I'm sweating my ass off over here. And then one time they come and they yell at me, don't go to the bathroom in between trailers, are you crazy? And I thought they meant that I went to the bathroom between the trailers. I'm like, I didn't go to the bathroom between the trailers. Are you crazy? Oh, no, you can't go use the bathroom. You have to go from one trailer to the next. So as you walk out of the place, all you can smell is Ben Gay. And Ben Gay's like an ointment if you're hurt. And the smell of, pee diapers, because people are, wearing diapers. So one day, I'm sitting there, and I had a couple beers with my buddy, and I'm supposed to be going into that job, and I'm like, I ain't going. So I called my mom, and I says, hey, Mom, I'm going to quit that job, because, I just graduated from Chabot College, and you guys bought me a suit, and so with the suit, I'll be able to find another job. My mom's like, okay, you're right. Go ahead, kid. So anyway. So, yeah, you may, get rid of some of these people. You may fire some of these people, but then, you're pushing people like that, and you may end up in a lot of times where people just aren't showing up because they can't stand the job anymore, and they finally like here, and now you're going to incur more overtime because now you got to pay these people to make up the slack of the time. So it's not always just, hey, let's, snap the whip and get people to work faster and so forth. Maybe we have to take a look at our own way that we're managing folks and seeing, is there some ways that we can get more efficient use of their time, get more out of them for the time that they're putting in. Maybe we could get rid of this, negative variance. We got an overall negative. Our rate variance, we might have to increase the rate that we're paying, and maybe we'll have what? Maybe we'll have more motivated workers, and that hours component of this variance will come down, right? Okay, so again, there's no one right answer, but certainly we kind of know what we're dealing with here now, don't we? In this sort of breakout of our budget by price and quantity would help us to do that. Okay, now there's also an example here for overhead. I'm not going to do the example in detail because often our overhead goes along with our labor variances, because what? If you're spending more time on labor, you're definitely spending more time on what? Indirect labor. You're spending probably more time on utilities and so forth and the other overhead components. And you can kind of see in this example that we simply changed the rates because of the overhead, but since the labor was driving our overhead, we had the same hours variances that we had in the labor calculations, and so we just simply changed the rate for the overhead rate versus the labor rate. Our overhead rate is going to be different, right, than our labor rate. Question? Okay, advantages. I do want to talk about an important disadvantage, though. Problem. So let's say you have a travel budget, and you have an unfavorable travel budget, and the unfavorable travel budget is because of efficiency. We're spending too many hours traveling, we're spending too much miles, we're traveling too much. So you put in a policy that now says we're not going to travel as much. That's how we're going to reduce that unfavorable variance on our travel budget. What happens? Employees stop traveling, what happens?
They're sad.
Huh?
They're sad.
They're sad if they like to travel. Look, how can I tell this story without sounding too bad? For some reason, I know the reason, but for some reason which I will not disclose, I stopped traveling as much with the government. I was having to travel all the time. And then all of a sudden I noticed, I'm not traveling as much, whatever. Was I happy or sad? Why was I happy? I was happy because I already had another job teaching. So when they used to make me go on the road, that meant I couldn't teach as much because I couldn't be there to teach the class. So I'm always like, okay. I would always get mad because, people would say, hey, do you want to go out and have some dinner and so forth? And I'd say, yeah, and I'd want to go to the nice place because I'm on the road. I'm in, a nice town, whatever. I'm visiting Chicago, whatever. I'm going to have some nice, food here in Chicago, see the sights, So I'd say, yeah, let's do it. And they always want to go to the cheap place. Oh, no. And they want to cry. And I'm like, screw you, because you get so much per diem per day anyway, whether you spend it or not. And they were trying to save their per diem. I'm thinking, hey, I'm losing money because I couldn't teach a class because I was making more than my bosses teaching and working at the same time. Cut. No. Okay, so what happens? You tell folks, don't travel as much, and the staff are happy because now they can teach more, right? But what happens? You're saving money on the travel budget, notwithstanding that they're doing some other work. Okay, forget that they're doing other work. What happens if they're not traveling as much? Your sales staff. Let me be more specific. Your sales staff. You tell them, cut back on that travel budget. You're spending way too much money on sales trips. What happens? They stop making the trips so that they're in compliance with the budget. Okay, boss, I'll get that budget number down. I'm not going to travel as much. Now what? Now they're not making sales calls. What happens when they don't make sales calls? Now your competitors go over there saying, I'm here, dude. I'm here. What's the matter? Oh, they're telling you them. Oh, let me show you, man. I got some materials they're the best. These materials here will produce themselves. Whatever. So you got to be careful with an analysis that tells you, well, okay, and you make this knee-jerk decision to cut. You have to think, what is what do they call that? The fallacy of composition. Fallacy of composition says, well, if I push this button, nothing else is going to happen over here. Meanwhile, you push this button, what? something bad's going to happen on the other side. So you need to have more than just sort of a tunnel vision as you take a look at these variances. Okay? Question? Okay. All right. Now look, that's it. Everything is due on Friday. Everything is due on Friday. I say with peace and love, everything is due on Friday. We will accept no reasons as to why you can't turn it in by Friday at 11:59 p.m. There will be no reasons that we will accept. So make sure you turn everything in. We will not meet on Wednesday. We will not meet on Wednesday because we have covered the material that I wanted to cover in this class. So we will not meet on Wednesday. 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 That means that you have an extra day to get your shit together so that you can turn everything in by when? Friday at 11:59 p.m. Okay, guys?